Happiest Minds has made a rousing debut today by listing at a premium of 111% at 351 rupees on BSE against the issue price of 166 rupees. Let's do a three-point analysis to find out what should investors do now. 1. What's the reason behind this stellar listing? Well, Happiest Minds with its listing has actually surpassed previous star debut performers DMart and IRCTC, both of which had also delivered over 100% returns on their listing days. Now, in fact, on an intraday basis, Happiest Minds has surged 138% to touch a high of 395 rupees per share. Now, the IPO had closed last week on a remarkable note with a strong response and also oversubscription by more than 150 times. Now, hopes are actually riding on the promising management. The company is also led by Ashok Soota, who is a pioneer of India's information technology services industry. He has already headed 3 outsourcing companies, including Mindtree and Wipro Limited, and has taken 2 of these public. Now, analysts say digital is the big theme playing out all over the world, and that's another reason for the huge interest that we are seeing in the stock. 2. Is the outlook promising? Well, according to Ashok Soota, the biggest strength of Happiest Minds is its outsized focus on digital. While no other IT bigwig allocates more than 50% of its focus on digital, in Happiest Minds' case, it is 100%, he has explained. Now, he also sees only 3 other companies in the world in the same league: EPAM Systems, Endava and Globant. Now, the company also reported healthy earnings even despite the COVID hit June quarter, and analysts expect that strong quarter-on-quarter growth in the near future is also going to be seen. Now, experts also point out at the scalable business model of the company, which has multiple growth drivers with experienced leadership and which is focused on sound corporate governance practices as well. 3. Should you book profits or stay invested? Well, given the stellar listing, experts have advised booking profits in the counter to short-term traders, while long-term investors can actually hold the script given the growth prospects of the company. Some experts have said that its growing customer base of high revenue generating clients, high proportion of repeat revenues and revenues from mature markets makes it a strong candidate for portfolio stock for the long term for investors. Now, Manali Bhatia, who is the head of research at Rudra Shares, has said that investors should hold on to the stock for long term. Now, she's also advised entering the stock in the range of 275 to 300 rupees and also to adopt an add more strategy on every fall and hold the stock for long term. Gaurav Garg, who's the head of research at Capital Via Global Research, actually believes that the company can generate double-digit growth rate in the next 5 years and also recommends holding the stock if they bought today for at least a few months.